At the beginning of 2026, Starbucks operated roughly 8,000 stores across mainland China. Then it gave up control. That spring, the company sold a 60% stake in its Chinese retail operation to Boyu Capital for $3.1 billion. Starbucks kept 40%, along with its name and intellectual property. Meanwhile, Luckin Coffee, founded almost 2 decades after Starbucks entered China, had expanded beyond 35,000 stores worldwide by May. From a distance, this looks like a retreat. But the real question is more uncomfortable. Starbucks helped create China's modern premium coffee market. Why did the company that taught millions of customers to pay for the coffee house experience decide it no longer wanted to run that market alone? The answer begins with a change in what Chinese customers were buying. When Starbucks opened its first mainland Chinese store in Beijing in January 1999, the bet was not simply that people would drink more coffee. The company was selling a place. Its stores offered carefully designed interiors and visible coffee craft with space to meet inside fast-changing cities. Starbucks later described this as a third place, somewhere beyond home and work. That positioning made the beverage only part of the product. A customer also bought consistency and access to a recognizable global lifestyle. The strategy worked. Starbucks expanded into more cities and built elaborate flagships that treated the store itself as media. In 2017, it opened the enormous Shanghai Reserve Roastery, its first outside the United States. China was becoming central to Starbucks' future, but the strength of this model created a blind spot. The larger and more carefully managed the experience became, the harder it was to compete with a rival that treated the physical CAF Chinese letter as optional. The clearest proof of Starbucks' confidence came in July 2017. The company agreed to pay about $1.3 billion for the remaining half of its East China joint venture. It was the largest single acquisition in Starbucks history at the time. The deal converted roughly 1,300 stores in Shanghai, Jiangsu, and Zhejiang into fully company-operated locations. Starbucks was paying a record price to own more operational complexity. Full control promised tighter standards and direct access to growth in one of the company's most important regions. Put that decision beside the transaction completed in 2026 and the reversal is extraordinary. In 2017, Starbucks paid to remove a local partner and gain control. 9 years later, it accepted a minority position and put a local partner back in charge. Companies rarely reverse a strategic principle this dramatically unless its economics have changed. While Starbucks consolidated its stores, a new competitor in Xiamen was designing a different kind of coffee company. Luckin Coffee was founded in 2017. From the beginning, its organizing idea was visible in the phone screen, not the furniture. In the prospectus it filed before going public, Luckin described a cashierless system where customers could choose a nearby store, order in advance, pay digitally, track preparation, and select pickup or delivery. In 2018, the company said more than 95% of its orders were placed through its app, supported by its WeChat Mini program and other platforms. That detail explains the strategic difference. Starbucks had built digital ordering around a valuable store experience. Luckin built stores around a digital transaction. Many locations could be smaller because they did not need to perform the same social function. The app also created a direct channel for vouchers, recommendations, repeat orders, and rapid feedback. This did not automatically make Luckin a better coffee company. It made Luckin a different distribution system. Starbucks monetized time and place. Luckin tried to monetize frequency and removed friction. Therefore, the two companies could sell similar drinks while competing on completely different economics. A digital transaction becomes more useful when a store is always nearby, so Luckin turned expansion into part of the product. The company mixed self-operated locations with partnership stores, allowing its network to spread faster than a purely company-owned model. By June 2023, Luckin had opened its 10,000th store. It finished that year with more than 16,000 locations in China. By the end of 2025, the global count had reached 31,048. 5 months later, Luckin said it had passed 35,000. Scale alone was not the whole strategy. In 2024, the company introduced 119 new beverage products. Its coconut latte became a repeatable hit, while unusual collaborations such as a latte created with Guizhou MOW Thai generated millions of first-day sales. This was a system built to test, distribute, and promote new products across a huge digital network. But speed can hide fragility. Opening stores and issuing coupons can produce growth before they prove durable economics. Luckin was about to demonstrate that danger in the most spectacular way possible. In 2020, Luckin's growth story collapsed. The United States Securities and Exchange Commission accused the company of fabricating more than $300 million in retail sales between at least April 2019 and January 2020. According to the complaint, employees used related parties to create false transactions and inflated expenses to conceal the fraud. Luckin agreed to a $180 million penalty without admitting or denying the allegations. Its American depository shares stopped trading on NASDAQ in July 2020. For many global investors, this looked like the ending. A fast-growing challenger had manufactured the appearance of success and been exposed. Yet the operating system underneath the scandal did not disappear. Luckin reported the misconduct, cooperated with regulators, removed personnel, and added controls while restructuring its debts. This does not erase what happened. It explains why the business survived. The fraud destroyed trust in the financial story, but customers could still open the app and collect a drink from a nearby store. That separation between corporate credibility and customer utility became Luckin's path back. Luckin emerged from its bankruptcy proceedings in April 2022. Then the network began compounding again. In 2023, revenue rose more than 87% and the store count doubled to over 16,000. By 2025, annual revenue had reached about $7 billion United States dollars, up 43% from the year before. The company reported an average of more than 94 million transacting customers each month and 31,048 stores at year-end. The expansion continued into 2026. Luckin finished the first quarter with 33,596 stores, then said the global network had moved past 35,000 by the end of May. This was a genuine operating comeback, but it was not frictionless. First quarter 2026 same-store sales at self-operated locations were nearly flat, and operating margins were lower than a year earlier. More stores can produce more revenue while making each store fight harder for demand. That matters because Luckin was not merely growing alongside Starbucks. Its scale and promotional intensity were helping change the price, product, and convenience expectations facing every chain in the market. Starbucks was not ignoring digital commerce. In 2018, it partnered with Alibaba to expand delivery and connect ordering with rewards across a broader online ecosystem. The company planned delivery coverage for more than 2,000 stores across 30 cities by year-end. By adapting a premium coffee house brand to digital convenience is different from building an entire network around it. By fiscal 2024, the pressure was visible in Starbucks results. China comparable store sales fell 8% for the full year. In the fourth quarter, they fell 14%, driven by lower average spending and fewer transactions. Starbucks cited intensified competition and a soft consumer environment. The company kept opening stores, but new locations could not fully offset weakening performance inside existing ones. The important point is not that Starbucks lacked an app or delivery. It had both. The deeper problem was strategic architecture. Every promotion or delivery improvement had to coexist with a brand built around premium pricing and the third place. Luckin could optimize the transaction first. Starbucks had to protect an experience while fighting on transaction economics. In November 2025, Starbucks announced its answer. Boyu Capital would acquire up to 60% of the China retail joint venture based on an enterprise value of about $4 billion. Starbucks would retain 40%, keep ownership of the brand and intellectual property, and license them to the new company. The transaction closed on March 30, 2026, for total consideration of $3.1 billion. The joint venture took responsibility for roughly 8,000 stores with a stated ambition to grow toward 20,000 over time. This was not a clean exit, and calling it one misses the strategy. Starbucks separated the parts of the business it still wanted from the part it no longer needed to control. It kept the globally valuable brand, a minority share of future growth, and ongoing licensing economics. Boyu brought local capital, local market knowledge, and responsibility for retail execution. The company that paid a record price for operational control in 2017 was now choosing leverage over ownership. The ownership split makes the reversal visible: 60% under local control, 40% retained by Starbucks. In plain language, Starbucks sold control. There's a harsh logic behind this structure. Operating thousands of stores requires leases and local supply chains, plus constant adjustment to consumer behavior. A global brand may be valuable precisely where a global operating model becomes less effective. By moving to a licensed joint venture, Starbucks can participate through brand ownership, royalties, and its retained stake while shifting more execution risk to a partner with local expertise. Boyu can pursue smaller cities and faster expansion without every decision traveling through the corporate system that protects Starbucks elsewhere. The cost is obvious: less control over how the brand is expressed and less direct ownership of the retail upside. Therefore, this deal is neither simple surrender nor automatic genius. It admits that Starbucks' strongest asset in China may now be the mermaid on the cup, not the machinery behind every counter. The market had become too important to abandon and too locally specific to run as before. Selling control was the price of staying in the game on different terms. Luckin did not challenge Starbucks by building a cheaper copy of the same third place. It changed the unit of competition. The fight moved from CAF Chinese letter beauty to network density, and from global menu prestige to local product speed. A familiar counter became a phone screen. Starbucks responded by changing what it owned. That may become the smartest way to monetize an enduring brand in a difficult market. Or it may mark the moment when the company surrendered its customer relationship to a system that had outgrown it. We will know by watching who controls product decisions and customer data as the joint venture expands, along with store economics and loyalty. But the reversal is already clear. In 2017, Starbucks believed China's future justified paying for complete control. In 2026, it decided the same future justified giving control away. Smart retreat or surrender? Tell me which side you take, and subscribe for the next hidden decision that changed a company everyone knows.